Get out now sounds dramatic, but when Warren Buffett, the world's most successful investor, starts selling his favorite stocks like Apple and Bank of America and is sitting on record cash, you pay attention. His moves scream, there's a problem. If he thinks it's time to pull back, maybe we should pay attention. In this video, I'm going to explain why Buffett's actions feel like a final warning and what that means for your portfolio. This year has reminded me of something. Markets can turn fast, and what looks safe to new investors today can really be dangerous tomorrow. Let me ask you this. If your portfolio dropped 30% tomorrow, would you panic or would you stay calm and act smart? A lot of people watching this video, understandably so, are going to say, I'll stay calm. I'm going to act smart. Why? Because we've seen drops and then the market goes right back up. Let me tell you a story. Back in 2022, I was talking with an investor who was panicking over a 20% drop in the market. He called me up, voice practically shaking, saying, Paul, should I sell everything? I told him, if a 20% drop scares you, what are you going to do when it falls 50%? When the markets are up, it's easy to say, I'm going to do this when the market falls. It's hard when it actually happens. Guy Spear writes this in his fabulous book, The Education of a Value Investor, that all these value investors he knew back in 06 and 07, when the actual time to buy value was there because prices had fallen, they were too scared. Warren Buffett once said, you shouldn't own common stocks if a 50% decrease in their price would cause you acute distress. The truth about investing is this. It's not about IQ. It's about temperament. It's about whether you can stay calm when everyone else is losing their minds. If you're lying awake at night, watching your portfolio fall, or scared about it going to zero, wondering if the market will ever come back, maybe you shouldn't be in individual stocks or stocks in general. So if you're thinking, I can't take this anymore, then Buffett would tell you, get out of individual stocks right now. Because when the next crash hits, and trust me, it will, the worst thing you do is sell out of fear. But if you can sit tight, if you can stomach the pain and think long-term, that's where the real money is made. Crashes don't destroy wealth. Behavior destroys wealth. So before we get into what Buffett is doing, let's talk about what's going on in the market right now, because if you're feeling nervous, you're not alone. Just last month, we were sitting in greed mode on the Fear and Greed Index. Everything felt great. Stocks were up, people were excited, and then bam, within 1 week, we flipped straight to fear. If you remember, this year started out in fear mode. The market went down, bottomed at April 8th, and then NASDAQ is up 55% since April 8th. Guys, that's only 6 months ago. And I get it. There's a lot happening all at once. People were worried about the government shutdown, wars going on around the world, tariff talks with China are falling apart again. We're also seeing cracks in the job market. Layoffs are starting to show up. Investors are wondering, why isn't the Fed cutting interest rates faster? And finally, inflation seems like it's sticking around longer than anyone wanted. Home buying is very expensive. Everything is much more expensive. And now the chatter is picking up on something new. Is there an AI bubble forming? We'll talk about more about that later in this video because trust me, it's important to understand and discuss. Now, I will tell you this. I'm not worried about the headlines one bit. The market is always going to have noise. That's just how it works. But there are two real issues going on right now that I am concerned about, especially for new investors. I'll share those with you right after we look at what Warren Buffett did, because what he's doing right now says a lot. Now, I'm going to go on a limb and say something that not many people are willing to say. I do think Buffett is trying to time the market like he did in the late 60s. In the late 60s, he closed his partnership up, returned everybody's money, and he admitted he did it because stocks were so overpriced, he didn't want to have 3 or 4 years of bad performance hurt his long-term returns. Right now, he is selling Apple and Bank of America, two companies he thinks are a foundation for the future. That, to me, tells me he thinks it's going to be bad. Because if he didn't think it was going to be bad, he'd still keep the companies and let them grow, and maybe they don't do as well, but he has a lot of cash, et cetera. It's still going to be fine. But to sell these companies he had a big holding in, that tells me he is worried about something very quick happening at any given time. He has almost doubled his cash in the last few years and selectively buying only what he believes is deeply undervalued. This isn't the first time he's done this either. Back in '99, before the dot-com bubble burst, Buffett had $15 billion in cash and didn't buy into the tech craze. Now you might sit there and say, Paul, $15 billion, nothing compared to $344 billion. Yeah, but the company now is worth 20 times more than that, so it's equivalent in terms of market cap. People mocked him, said he was a dinosaur, said he was out of touch. Then the bubble popped. And once again, he was the smartest guy in the room without fail. Now, obviously he can be wrong. But even in past years, he has said it's challenging to find good deals, but he still bought Apple. He still kept his Bank of America. So for him to go sell on these two companies tells me that he feels there's an imminent bad market coming and he will just wait and let the market decide what's the right thing for him to buy. But he's not panicking. That's not him panicking. It's preparing. It's just him doing what he always does. Patience, discipline, waiting for value. And that's what we need to be doing, but a little bit different than him. Now, the reason Buffett and other wealthy people can try to time the market is they don't need to be in the market. They can sit making 3 or 4% on treasuries for the rest of time and have far more money than they ever need. You are not the same way. You need to save for retirement. You're not going to guess when the market goes up or down. Your job is to dollar cost average every single month. Now, buying individual stocks is a different story, but with the long-term ETFs, it's important to buy those consistently. That way you're buying when it's overpriced, underpriced, but you'll end up matching the market either way. And you can do quite well even with a bad bear market. But how do you do quite well? By ignoring the emotion of it. Buffett's very well known for what's become the Buffett indicator, the stock market to GDP ratio. But what's happened recently is the stock market to GDP ratio, that portion of the stock market relative to the entire economy, has grown to an insane level. Levels we haven't seen since the roaring 1920s. Double the level we saw back in 2000. Now, what I want to show you here is my own stock market GDP ratio based on the S&P 500. Guys, the more you pay for something, the less return you make. This iPhone's worth $1,000. If you pay $500 for it, you double your money. If you pay $1,500 for it, you lose 33%. Makes sense, right? Well, same with the stock market. When we're undervalued, historical average for 100 years, 400 quarters is 6.4% every year for 10 years on average, not including dividends. When we're undervalued of 30% or more, it's 10.7%. And as you get more overvalued, what happens to returns? 9%, 2.1, negative 1.1, negative 1.8, negative 2.3. It makes perfect sense that as you pay more, your returns in the future are less. Guys, we're 119% overvalued. This negative 2.3 is based on 50% overvalued. Guys, I will absolutely say this. The next 10 years are not going to be good for the stock market, but it doesn't mean you should get out now. I cannot repeat that strong enough. The reason being is, if you guess to get out now and you're wrong, you're going to miss out on a lot of gains. Is it possible that GDP skyrockets? Absolutely. How? Well, we're printing money like crazy. That causes inflation. That causes GDP to skyrocket. This fair value in the S&P here, 2993, just 4 or 5 years ago, was way lower. Back in COVID, it was 2,000. 2,100 was fair value. That's a big difference. So what does this all mean for you? It means if you buy when prices are high, you can't expect big returns, and that's the goal of this video. It's to manage your expectations so that when you have the next 10 years that aren't great, you don't sit there and get down about it. You sit there and go, well, that was expected, but what's going to happen is it's going to flood the other way. At some point, the market's going to go from overvalued to undervalued to overvalued to undervalued. But this is the fair value over time. You're buying all along the way. But over time, you're paying the average. That's what matters. It keeps you disciplined. It keeps you on the right path, and it avoids making emotional mistakes. That's going to be tough. Not impossible, but tough. You've got to be the kind of person who's ready to look at this and say, I don't need this money for 30 years, 20 years, 15 years. I can ride these out. And when markets fall hard, you're the person saying, I'm getting a great deal on stocks. That's what I want you to think. I'm getting a great deal on the US economy. Because guys, guess what? I have shown this other chart so many times that I love it for exactly this reason. This is the stock market going back to 1950. If I were to tell you to pick 5 or 6 times to buy the stock market, you'd pick here, 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 right? Guess what? My friend who emailed me freaking out, emailed me right here. Yeah, it wasn't the bottom yet. And they felt pretty good after they saw it fall more. They didn't get back in until here. So they could have been buying all the way here. They would have spent an average of this and made a lot of gains. But instead, they felt good in the short run and not realizing how much they miss in the long run. I heard a great quote today in Morgan Housel's book, The Art of Spending. He's actually quoting somebody else who said, personal finance is more personal than finance. I could teach you all these numbers till we're blue in the face. If you don't have the personal objectives right and the personal stomach to handle all this, it does not matter. You can understand cash flow and balance sheets till you're blue in the face. But if you can't handle these fluctuations and being able to do the right thing at the right time, it is not going to matter. So the question is, what's causing this overvaluation? We've been living through one of the biggest bull markets in history since COVID, and it wasn't powered by boring stuff. It was led by tech stocks, electric vehicles, semiconductors, and now AI. And right now, the S&P 500, the index that everyone uses to track the market, is being completely dominated by just a handful of massive tech companies. I'm talking about Apple, Microsoft, Nvidia, Google, Amazon, Meta, Tesla, Broadcom, Oracle, and the list grows as new companies enter and start doing better. These 9 companies have gotten so big, so fast, they now control a huge piece of the market. Tech alone makes up over 33% of the S&P 500. Nvidia, just one company, is now 7% of the entire index. So, one company out of 500, 0.2% of the entire market in terms of number of companies, makes up 7% of the entire index itself. Think about that. Now, compare that to 2000, the exact same number. Basically, 33% of the S&P 500 was tech back in 2000. And since late 2022, AI stocks have driven about 75% of all the S&P 500's gains. But here's the catch. In investing, when too much weight sits on too few companies, things start to wobble. It gets uneven. And history tells us this always ends the same way. And we'll talk about how that plays out shortly. But first, let's talk about why this concentration matters so much. Right now, these companies aren't just big. They move the entire market. If they go up, the market goes up. If they go down, the market goes down. And here's what's got the pros talking. Some experts now say we might be in another bubble, this time an AI bubble. And every time I hear people say some variation of this time it's different, because they don't say those words exactly because they know how dumb that sounds, that's when I start looking for what's coming next. Because when hype takes over, I look at behavior to determine it's different this time. Is it very easy to make money? Do we feel like if the market fell 30%, we'd want to buy more? Those are indications to me that people aren't really remembering what it's like to have a bad market for a longer period of time. Look at COVID. We went down 40% in 1 month and then rebounded. And by the end of the year, we were in the positive at new highs. When hype takes over and stocks go straight up for no apparent reason besides you can't miss out, FOMO, nobody's asking what anything is worth anymore. And that's when it gets dangerous. And remember this in investing. Price is what you pay, value is what you get. And the only goal we have is the same goal that you have when you buy a car, a shirt, a house, anything. You want to pay less than value. But right now, people are paying a lot. Now, we don't know the future. I could be very wrong on this. The last few years, I've been saying the market's overpriced, and the market keeps trucking up, and fair value keeps going up. I fully acknowledge that. But the one thing I've been consistent about is saying, okay, then what does this mean? Is this going to go up forever like this? Let's play that out. If the market's going to grow 14, 15% a year for the rest of time, that means the stock market will become 100 times the entire US economy at some point. Is that feasible? I like to look at those extremes to realize there's somewhere in the middle that makes sense. These are great companies. Those 9 companies I mentioned are all great companies, but there's got to be a price to pay for great. If there's not, you're not investing, you're speculating. You're not going to hear this from anybody else on YouTube. What about the media? Guys, everybody's just focused on clicks. More creators are more interested in guessing the next hot stock than teaching you how to think. It's far more important for us to teach you how to fish than it is to give you fish. We are not here to give you fish. We are not chasing hype. We're chasing truth. But underneath all the noise, underneath all the headlines, all the fear and greed, there's one thing that actually matters that people always ignore: valuation. When I say they ignore it, when the market's going sky high, valuation doesn't matter. Why? Because you're missing out on the story, Paul. Great. When the market's crashing, valuation doesn't matter. Why? Paul, you're missing the story. Things are just going to zero. Okay, fine. There's a few people watching this video who will realize, wait a second. The market goes down, it goes back up always in history. The market goes up to insane levels and always comes back down to more normal levels. I'm hoping you're that person watching and saying, Okay, there's got to be a better way to understand this. In the short run, stocks are a voting machine. In the long run, they're a weighing machine. And trust me, it sucks to go against the crowd, but that's where real wealth gets built. And it's exactly what most people ignore, or they never even learn in the first place. So consider yourself lucky that you're even able to come learn this. So if you're tired of being fed the hype and the headlines, and you're ready to actually understand how investing works in the long run, you're in the right place. And that's exactly why I teach on YouTube. I used to teach it in a high school class just for fun and for free, and I thoroughly enjoyed it. And somebody in my office said, Paul, we need to translate this to YouTube because a lot of people need to hear the message. And I was like, okay, let's do it. And it's been fun. I will never, ever tell you what to buy besides low-cost ETFs. I will never tell you when to buy except a dollar cost average. What I'm trying to teach here is a way of thinking. Because remember, your life has a lot of situations, and you're going to invest differently than I am. I'm going to invest a lot different than you. But just like you, I own low-cost ETFs. Just like you, or what you want to do, I own individual stocks. And over time, that's going to become a bigger part of my portfolio. But the real lesson to learn here is the emotional side of investing. So let's talk about what really matters in all of this. Who actually survives when the market crashes? And when I say survives, we all live. I get that. But who actually profits from it? Because the truth is, not everyone's going to make it through with a lot of profit. When things get ugly, the people who aren't prepared emotionally get wiped out or get scarred and permanently hurt a long piece of their future. But the ones who survive tend to have the same traits every time, and they're not complicated. Let me walk you through them. First off, you're not going to have the money Buffett has. But he once said, cash combined with courage in a crisis is priceless. Now, if you're dollar cost averaging every single month in a low cost ETFs and the market falls, and you're able to figure out a way to buy more, that's how you can really make a lot of money. Buy when the market's undervalued, put a little bit more in there. Now, it's not for everybody, and it's not possible for everybody, because when the market crashes, maybe the economy is in a recession, jobs are tight. But I'm sitting there telling you that as an option for if the market were to crash. If you're able to be patient going up, you'll be patient going down. It takes patience to wait for that market to rebound. Second, the people who do well understand what they own. If you own low-cost ETFs in the market, you know you own a piece of the U.S. economy. If you think the U.S. economy is not going to zero, you're going to do very well. When a crash hits, most people don't sell because they want to. They sell because they don't know what they own. They're guessing, they're hoping, there's fear there. But when you understand what's behind every ETF and stock, you don't panic when the price drops. Buffett doesn't look at a stock like it's a lottery ticket. He sees it as part ownership of a real business. And if you own an ETF, you own a piece of a lot of businesses. You own a piece of the U.S. economy. And if that business fundamentals are still strong, the lower price just makes it a better deal. Third, they avoid debt. Now, it's not really avoiding debt, it's having manageable debt. Even Warren Buffett in Snowball talked to his kids who wanted to sell shares to go live their life. He said, borrow against your stock. Borrow 25% to go live, let the stock grow. But it's about using crazy debt. I just saw an Instagram post the other day where some guy was bragging about having 11,000 to 1 margin. That means for every dollar of equity, he had $11,000 in debt. Guys, that's insane. That's absolutely insane. In real estate, for every dollar of equity, I have $3 of debt. This 11,000 to 1, that's the crazy stuff. There's a company called Long-Term Capital Management from back in the 90s that had insane debts like that, and they were making 40, 50, 60% a year for 3 or 4 years, and then they went to zero in a matter of weeks. Because if you borrow to invest and the market drops, you might be forced to sell at the worst possible time. Charlie Munger said it best, if you're smart, you don't need leverage. If you're dumb, it'll ruin you. There's nothing more dangerous than having no margin of safety when the market turns. Fourth, they control their emotions. This is probably the most important one. Crashes can bring the worst out of people. Fear, panic, regret. But the investors who survive, they just look at it as an opportunity, because that's what it is. They don't make decisions based on headlines or red numbers on a screen or on their tax return. They remember, fear creates opportunity, greed creates danger. Fifth, they think in terms of decades, not days. I used to love it. Back 60 years ago, the average hold time for a stock was 7 years. Now it's like literally days or, I don't even know the exact number, but it's like days or weeks or something. A market crash doesn't mean the world is ending. It just means that prices are falling. That's normal. We've had them in the past. We will continue having them in the future. But the people who survive and profit from a crash are the ones who know they're not in this for the next 10 days. They're in it for the next 10, 20, 30 years. I love what Buffett says. If you're not willing to own a stock for 10 years, don't even think about owning it for 10 minutes. He's right. Because real wealth comes from owning great companies over time, not from trying to play the market like a game. My intention when I buy a company is to own it forever. But it doesn't mean I don't change my mind during it or find an opportunity that's better, that I can sell a one that's overpriced and go to a new opportunity. It means your intention is, this is a great company. If the market went away for the next 10 years, I'd be happy owning it. That's a lot different than actually keeping it 10 years. Let's go a little bit deeper, because I'm going to show you some actionable steps on who actually profits from a crash and how you can be one of them. So here are the action steps. First, deploy your cash into great businesses, whether that's an individual stock or a low-cost ETF or what I do, which is a combination of them. Don't stop investing now. What I'm saying is, don't sit on the sideline when it happens. Second, do your homework now. Learn what makes a business valuable. Understand the difference between price and value. That's so important. You're always trying to look for something on sale. Because when stocks drop, you need to know what's actually on sale and what's just garbage getting cheaper. Let me show you an example. Look at a company like NVIDIA, the hot stock of today. I'm looking at the last 1 year. Guys, right here, it tells me the low for the last 1 year is $86, the high is $195. Are you really telling me that you believe the price of NVIDIA should have changed this much in 1 year? No. But the price did. Did the value of NVIDIA change that much? Absolutely not. If you believe that, because NVIDIA is a very mature, big company, if you believe that somewhere in there is a better price, then you can understand this. The fact the price goes up or down does not mean the stock's value has gone up or down. There is a difference. When stocks drop, you need to know what's actually on sale and what's just garbage getting cheaper. Third, have a watch list. Know which companies you'd love to own at the right price, because when panic hits, you need to be ready to act while everyone else is frozen. This is my watch list, and I'm going to get notified anytime a stock on this list hits the price I want it to. I get an email, I get a notification on the phone app. All these things happen because I want to be ready to act. And the most important thing I talked about earlier is price is what you pay, value is what you get. When the markets crash, prices drop fast. But if you own a great business, the value doesn't disappear. Yes, maybe the temporary value went down. There was a recession, revenue went down, profit went down. But that's a temporary thing. You have to think in terms of long term. This is exactly why I don't panic when prices swing. I stay focused on the difference between hype and reality, between price and value. This is exactly what principle-driven investing is all about. It's not about predicting the market in the short run. It's about staying calm, using market prices to your advantage, thinking logically, and knowing exactly what you own and why. But guess what, guys? We looked at NVIDIA. If NVIDIA went from currently $181 down to $18 tomorrow. Sounds unreasonable, right? There'd be a story about why it's a crappy company, and I'm willing to bet the revenue would still be up. The example I always give was when Amazon in 2000 went from $116 a share down to $6, $113 a share down to $6. And there's a great interview with Bezos, and this is how he really learned what fundamentals were about. He sat there and said, so the stock was down 95%, but literally every single metric we had on the business was showing better numbers than when we were at $113 a share. That's when he realized there's a disconnect here. We're not here to predict the market, ever, in the short run. Now, guys, to help you stay focused, I put together a free PDF that breaks down these 5 core principles that I call principle-driven investing that I follow every single day, not just for stocks, but for real estate and anything else I buy. First off, I'm an investor, not a speculator. Second, every investment I make is going to be the present value of all my future cash flows. Third, if we don't understand it, we don't buy it. Doesn't mean it's not a good buy. It just means if we don't understand it, we don't buy it, because if we don't understand how it's going to make money, we have no idea how we're going to lose money. In the short run, stocks are a voting machine. In the long run, they're a weighing machine. And the fifth and probably most important one, a great story can become a bad investment if you pay the wrong price. This guide is simple, it's clear, and it works. It's your cheat sheet when emotions are high and the noise gets loud. So click the link in the description, because if you stick to these principles, you're going to beat over 90% of investors without ever guessing where the market goes next. And finally, I need you to be patient. The market will crash several times in your lifetime. I don't know when. No one else does. But if you're prepared, you will be the person enjoying the next crash like I did in '06 and '07, like I did during COVID. It'll be your opportunity. And if the market does crash, stocks will be a lot cheaper from a value standpoint. And it's exactly why you need to learn the valuation skills now. If you believe that stocks can be overvalued, you believe they can be undervalued. In this next video, I'm going to walk you through exactly how I think about valuing stocks. That way, when prices swing and everyone else is losing their minds, you'll be calm, you'll be confident, and you'll be prepared to act when there's fear in the streets. The link is right here on your screen. Don't miss it. And this is how you get ready for your moment. Thank you for your time.